Good evening, everyone. My name is Jennifer Bidadole. Tonight, together with my group members, Shairil Baguio and Noel Istania, we will be discussing Chapter 9 of Managerial Accounting 13th Edition, the Differential Analysis and Product Pricing. Our learning objectives for this chapter is to prepare differential analysis reports for a variety of managerial decisions for lease or sell, discontinue a segment or product, make or buy, replace equipment, process or sell, and accept a business at a special price. But tonight, I will be discussing to you how to make a differential analysis reports for lease or sell, discontinue a segment or product, and make or buy. The rest of the topics will be discussed to you by my group member, Noel Istania. What is a differential analysis? Differential analysis is sometimes called incremental analysis, which analyzes differential revenues and costs in order to determine the differential impact on income of two alternative courses of actions. It is also a method of making decisions that analyzes the net outcomes of two options after examining the cost and benefits of each. The key to effective decision-making is differential analysis because it focuses on the future costs and benefits that differ between the alternatives. What are to be considered in preparing a differential analysis? Differential revenue. It is the amount of increase or decrease in revenue that is expected from a course of action compared to an alternative. Differential cost. It is the amount of increase or decrease in cost that is expected from a course of action compared to an alternative. Differential income or loss. The difference between differential revenue and differential cost. Differential income indicates that a particular decision is expected to be profitable, while a differential loss indicates that decision is expected to decrease income. There are 5 steps in decision making. Step 1 is to identify the objective of the decision. Step 2, identify alternative course of action. Step 3, gather information and perform a differential analysis. Step 4, to make a decision. And finally, step 5 is to review, analyze, and assess the results of the decision. Here is an example in applying the 5 steps in decision-making process. Let us assume that Bryant Restaurants Incorporated is deciding whether to replace some of its customer seating tables with a salad bar. So the first step that Bryant should do is step 1, to identify the objective of the decision. So what is Bryant's objective in this decision? His objective is to increase income. Step 2. Identify alternative course of action. The following are the alternative courses of action that Brian should do. A. To use floor space for existing tables, or B. To replace tables with a salad bar. Step 3. Gather information and perform a differential analysis. Here in Exhibit 1, a differential analysis for tables or salad bar is being shown. The first column shows the revenues, costs, and income for maintaining floor space for tables. The second column shows revenues, costs, income for using that floor space into a salad bar. And the third column is the difference between the revenue, cost, and income of one alternative over the other. The salad bar is being considered over retaining the existing tables. The differential revenue of a salad bar over tables is 20,000, while the differential cost of a salad bar over tables is 5,000. The difference income of a salad bar over tables is $15,000. It is determined by subtracting the differential cost from the differential revenues in the differential effect on income column. Thus, installing a salad bar increases income of $15,000. And the last step in the decision-making process is step 5, to review, analyze, and assess the results of the decision. So Brian's Restaurant's choice should be re-evaluated over time based upon actual sales and expenses. It could be essential to do another differential analysis to confirm that the right choice was chosen if real revenues and costs differ significantly from those compiled in step 3 data. And now let us proceed on the illustration of differential analysis for the following common decisions. First is the lease or sell. What is lease or sell? Management may lease or sell a piece of equipment that is no longer needed. In making a decision, differential analysis can be used. Only the differential revenues and differential costs associated with the lease or sell decision are included in the differential analysis. The book value of equipment is a sunk cost and is not considered in the differential analysis. Sunk costs are costs that have been incurred in the past, cannot be recouped, and are not relevant for future decisions. Here is an illustration for lease or sell. On June 22, Marcos Company is considering of leasing or disposing equipment that costs $200,000 and has an accumulated depreciation of $120,000. The equipment can be sold to a broker for $100,000 less 6% commission. The Dulles Company or the lessee offered to lease the equipment for 5 years for a total of $160,000. At the end of the 5th year, the equipment is expected to have no residual value. During the period of the lease, Marcos Company expects to incur repair, insurance, and property taxes estimated at $35,000. Exhibit 2 shows the differential analysis of whether to lease or to sell the equipment. If the equipment is sold, differential revenues will decrease by $60,000. The differential cost will decrease by $29,000, and the differential income is a decrease of $31,000. Thus, the decision should be to lease the equipment. In this exhibit, it includes only the differential revenues and differential costs associated with the lease or sell decision. The $80,000 book value of the equipment is a sunk cost and is not considered in the differential analysis. Another common decision in the decision-making process is to discontinue a segment or product. A product, department, branch, territory, or other segment of a business may be generating losses. As a result, management may consider discontinuing or eliminating the product or segment. In such cases, it may be erroneously assumed that the total company income will increase by eliminating the operating loss. Discontinuing the product or segment usually eliminates all of the products or segment's variable costs. Such costs include direct materials, direct labor, variable factory overhead, and sales commissions. However, fixed costs such as depreciation, insurance, and property taxes may not be eliminated. Thus, it is possible for total company income to decrease rather than increase if the unprofitable product or segment is discontinued. Illustrated in Exhibit 3 is an income statement for Battle Creek Cereal Corporation showing its income from operation for the year ended August 31, 2016. Corn Flakes has income from operation of $40,000. Toasted Oats has an income from operations of $40,000. However, Bran Flakes suffers an operating loss of $11,000. Because Bran Flakes has incurred annual losses for several years, management is considering to discontinue the production of Bran Flakes. However, the differential analysis dated September 29, 2016 in Exhibit 4 indicates that discontinuing Bran Flakes, or the alternative to, actually decreases operating income by $15,000, even though it incurs a net loss of $11,000. This is because discontinuing Bran Flakes has no effect on fixed costs and expenses. Exhibit 4 only considers the short-term effects of discontinuing Bran Flakes. When discontinuing a product or segment, long-term effects should also be considered. Product case or revenue of $65,000, variable cost of goods sold of $50,000, variable selling expenses of $12,000, and fixed cost of $25,000, creating a loss from operations of $22,000. Prepare a differential analysis dated February 22 to determine if product case should be continued or discontinued. Assume fixed costs are unaffected by the decision. Following the solution of this example 9-2, the differential analysis for product K should be continued. The last topic for differential analysis that I will be discussing tonight is make or buy. Companies often manufacture products made up of components that are assembled into a final product. For example, an automobile manufacturer assembles tires, radios, motors, interior seats, transmission, and other parts into a finished automobile. In such cases, the manufacturer must decide whether to make a part or purchase it from supplier. Differential analysis can be used to decide whether to make or buy a part. The analysis is similar whether management is considering making a part that is currently being purchased or purchasing a part currently being made. To illustrate, let us assume that an automobile manufacturer has been purchasing instrument panels for $240 a unit. The factory currently operates at 80% of capacity. The cost per unit is estimated as follows: direct materials $80, direct labor $80, variable factory overhead $52, fixed factory overhead $68, with a total estimated cost per unit of $280. An illustration of this differential analysis is shown in Exhibit number 5. The differential analysis for this make or buy decision is shown in this Exhibit 5. If the make price of $280 is simply compared with the buy price of $240, the decision is to buy the instrument panel. However, if unused capacity could be used in manufacturing the part, only the variable factory overhead costs would increase. The fixed factory overhead cannot be eliminated by purchasing the panels. Thus, both alternatives include the fixed factory overhead. The differential analysis indicates that there is a loss of $28 per unit from buying the instrument panels. Thus, the instrument panels should be manufactured. These are all my topics for the differential analysis. The next topic will be discussed to you by Ms. Noel Istania. Thank you and good evening.